Thank you, everyone, for joining. We're here to discuss the 2025 market outlook, new leadership, changing landscape. I am joined by Marianne Bartels, who is the Chief Investment Officer at Sanctuary Wealth, formerly spent a number of years at Merrill Lynch, which is where I was introduced to Marianne and have been following her market calls and charting. And thank you very much for taking the time today to discuss the markets. And appreciate everything that you'll share with us here today. Marianne, thanks for joining.
Well, thank you. It's absolutely my pleasure. There's new news, it seems, every day to digest.
Exactly. So we'll kick this off here. Just a couple of items. Feel free to use the chat or even the Q&A feature on the webinar. I'll be looking at that and tossing up questions as we go along. I do have a couple of questions that were sent to me from clients that I will throw up to Marianne as we kick off through the presentation. I'm also going to do a little bit of charting. So Marianne, if there's anything you want me to show in addition to kind of what you're describing, I'm happy to do that. But I love this. So it's the beginning of the year and there's been a lot of change. Just like you said, every day things seem to change with the markets, with President Trump and this administration. Could you give me the three, say, macroeconomic themes or trends that you think are going to shape markets for 2025? What should we be looking for? What are you looking for?
Well, the first thing I have to say, the Trump administration has done a lot, and there's a lot of news that the market has to digest, particularly on tariffs. Mm-hmm. And the market was holding up extraordinarily well. The last day or so, the market has been struggling again with tariffs. Markets, I think, can operate well with tariffs, but they need to know the details, and we don't have all the details. It's I may do this and throw out a number and then it gets changed. So the market needs to know facts. And I think when the market knows facts, it can digest that, process it, and move on. I've always argued at the end of the day, what makes stocks go up and down, the markets go up and down, are earnings. And we're in the tail end of fourth quarter earnings. And again, significant beats by corporate America. Earnings are beating by 6%. They're up 16% year on year. And so there's justification for markets hitting record all-time highs. So I think that's very important to realize that the earnings power is there. Now, there's something that you're not hearing a lot about that can power these markets higher. The government has already hit their debt ceiling.
Oh, right.
That means that they can't issue new debt. They can roll over existing debt, but they can't issue new debt. What they can do, however, is go into what's called the Treasury General Account, or TGA. If you see TGA, that stands for Treasury General Account. Now, what's interesting about this is when the Treasury issues debt, it's selling it, mm-hmm. right? So normally it's taking money out of the system when they do that, right? Its money is not in the banking system because somebody bought the treasuries. In the TGA, it's actually in the banking system, and they have to put money in the banking system, that particular operation. And by doing that, it's a way of creating liquidity for markets. It's not something we normally see because we're not always at the debt ceiling.
Right.
If this continues through March, it's estimated that $500 billion in liquidity will be created.
So that sounds like a lot. Is that as much as I think it sounds?
It's a ton of money.
Yeah.
And it can really lift risk assets, and it's not getting a lot of attention. And the reason why it's not getting a lot of attention is one individual on Wall Street actually figured this out. His name is Dan Clifton. He's at a macro research shop called Strategas. I happen to get their research. I'm also friends with them. I've known them for a really long time. And so the market's not really focused on this. And I think that's very important for risk assets. even if you think about it, that it puts a floor, just having that liquidity there should put a floor on the equity market. What's also interesting, what we just started to hear about, is that the Trump administration is thinking about giving a special dividend to the consumer based on the savings.
Right.
If the government did that, that would be bullish because it's putting money in the hands of the consumer. Whenever you put money in the hands of the consumer, it gets spent.
Right.
And that's bullish. At the end of the day, the consumer is probably the key to the economy. We're at full employment. I would argue we're even past full employment. That means, okay, people are employed, people are getting a paycheck. The consumer's not dead. You recently just heard about retail sales in January and how bad retail sales are. Well, have you looked at the country and the weather? Weather impacts consumer spending. So a lot of the lack of consumer spending actually has to do with bad weather. So I don't think the recent retail data is a sign that the consumer can't spend. In fact, when we look at credit card data and spending data overall, the consumer is still strong. In fact, Walmart reported earnings today, and in their statement, how they classified the consumer was steady. That's important because Walmart services a wide range of the consumer, but particularly what we consider the low-end consumer. And there's been a lot of concern about the low-end consumer. But if Walmart is saying the consumer is steady and still spending, that's another really good sign for our economy. So our economy is growing.
So going back to the liquidity, and you mentioned stocks, well, what would that do to interest rates if all of this liquidity hits the market?
Well, it tends to hit the equity market more than the bond market, but it can hit the bond market. According to Dan Clifton, though, he thinks this money can actually lower interest rates. He's forecasting which bond prices are up, interest rates down. And that is possible even from a technical perspective, that we get a rally in the bond market and a rally in the stock market. That would be very welcomed by investors because we haven't been seeing that. We've been seeing the opposite. Where fixed income has not been performing well, and we've been getting great performance out of the equity market.
Absolutely.
So I remain very bullish. Our year-end forecast, I give a range because having one number is futile. I don't know anybody that can hit a year-end target, but you can do a general range, and our range is 7,200 to 7,400, which is basically forecasting another 20% return this year, which in most instances is considered absolutely insane and crazy because statistically that normally does not happen.
Three back-to-back 20% S&P 500 years.
Correct. Has only happened one time, and that was from 95 to 2000. So we actually had from 1995 to 99. In every one of those years, the market was up 20% or more. Even though we had bear market corrections in 97 and 98, we still closed up over 20%. I really am comparing this market cycle to the mid to late 90s, where we had productivity enhancements from computers, and then we had the whole craze of the internet. And then I've also compared it from 1925 to 1929, really looking at innovation and how an economy can transform. Now, we don't think of, going from horse to a car as innovative, but back in the 1920s, going from a horse to a car was transformative.
Sure.
Rails, printing press, electricity, these were major forms of innovation. And when we looked at the economy grew. And as the economy grew, companies had earnings and the stock market went up. Now, the ending is not so pretty for either comparison. And there is a risk that we can repeat it where the ending is not so pretty. But let's ride the ride while it's here. And I think this new innovation, and what we have to realize, we talk about artificial intelligence as being the only innovation. It's not just AI, it's blockchain, it's cryptocurrencies, which I bucket under Web3. This is important. When we first came out with the internet, it was read only. Then we went to Web 2, which was read write. We're in the process now of creating the third generation of the internet, which is read, write, own. That doesn't get talked a lot about. That's really very important. We also have virtual reality. Look at Meta. Meta's been in the news because the stock went up for 20 days in a row, and they're the leaders in virtual reality. So we have a very complex, wide range of innovations that are happening. And the key is most of these innovations are occurring in the United States. Most of the companies that are creating this innovation are housed in the United States. And this is impacting our stock market. So when we look at where the breadth of the leadership and the breadth of the earnings, it's in these like Magnificent Seven, or what we used to also call FANG. Mm-hmm. So I'm not concerned like I was back in the 90s that companies were going up but didn't have earnings and didn't have great balance sheets. Today, the story is the complete opposite. We have companies sitting on billions and billions of dollars of cash. Understandably, they're starting to spend it on innovation, but they're not leveraging. And they're the ones with the bulk of the earnings right now within the marketplace. So that's going to keep powering, I think, the markets higher.
Yeah. And you mentioned leadership, and I know since our conversations and I've been following you believe leadership has been technology. You know, this year is just the last 5 years. You can see the S&P has almost doubled. And if we look at the NASDAQ over that same period of time, we've seen more volatility, but now 130% compared to 96% positive. Certainly this trajectory you believe to continue if we're talking about another up 20% year. We've been overweight growth, have maintained that overweight. You think leadership is going to continue to be technology? How long or when do you see that breaking?
I still think it's leadership. So the rule of thumb is when you're in a secular bull market, which we're in, which we began for the S&P in 2013 and for NASDAQ it was 2017, meaning that we broke the previous highs. That's when you start a new secular trend. When that leadership of that secular trend is the leader, and when it ends, it's normally the end of the secular trend. And I'm expecting the leadership of technology or tech related, right? Because we have communication services doing really well. That's where Meta is. That's where Google is. That's where Netflix is. That's a strong leader. You have Amazon, you have Tesla in consumer discretionary. So when we talk about tech, we really have to say tech and tech related, because technology is basically across the whole market, but those are the three sectors that really house the major leaders. And so I see them as staying leaders back to the end of the decade, to 2029 to 2030. And I think we're in a super cycle for growth. Now, there's going to be periods of time where growth digests, which we're in a period right now that I believe that is happening, and value outperforms, but I see no leadership characteristics emerging from value. I actually think we're in a super cycle for growth. I think we're in a cycle that we've never seen before, that will far surpass the cycle that we saw in the mid to late 1990s. And the NASDAQ will remain the leader. And I've kind of nicknamed the NASDAQ the digital index because it houses, we're in the digital era. And that's where most of the companies are sitting, are in the NASDAQ.
Yeah. Last 3 years, it's leveled out a little bit just because that included 2022 and 2023 where the NASDAQ sold off a little bit. But the last 1 year has been, a NASDAQ up 50%.
Yeah, which is not normal.
Yeah.
It tells us that we're in a very, very different cycle. And, I look at cycles, and sometimes when I talk about these things, they sound ridiculous, but they actually work. So there was a gentleman many, many years ago, I think going back to the early 1900s. So there've been people studying market cycles for a very long time. And one of the cycles are called the decennial pattern. And they came up with this concept, I think like in 1918, where you look at the return of the market over a whole decade. So you look at year 1 through year 0, like 1, 2, 3, 4, 5, all the way out to 10, but 10 would be 0. And then you would average all the returns and look at that over a period of time. Well, there's cycles that occur. Zeros tend to be really bad. Years that end in zeros tend not to be very good. 8s and 9s tend to be good cycles, but 5 is the best. The mid part of the decade tends to have the strongest returns on average. And we've updated this from the 1900s to today. On average, in year 5, you're up around 18 or 19% year to date. So I know it sounds really kind of silly, but then on top of that, we also look at presidential cycles. You know, Trump having a re-election and a break in between, there's only one other time that happened. So most of us are counting Trump as first administration, but he's kind of smarter at it because he's done it before. But the first term of a president also has excellent returns. So when you combine the presidential cycle with the decennial pattern, they're just two bullish factors. The other thing is, and again, I know these are silly, but they're fun facts. When the month of January is up, most of the time, 80% of the time, the year is up, and we were up in January.
Right.
So these are just like fun facts, fun statistics. So everything seems to be kind of moving in our direction.
Yes, what you track is amazing, and there's no shortage of fun facts that you have. I want to get into the leadership, Washington policy changes, but before we get off of leadership is going to be technology. If you're correct, where in technology? Because what we do is we do overweight. We make some tactical overweights and underweights, whether it's U.S. versus international, or large versus small, or growth versus value. But generally speaking, we believe in diversification. We believe in asset allocation. We never really go really bullish in overweight stocks or really underweight them. We're more longer term. With that said, you've made some amazing calls in the past, one of which was semiconductors, which has been great for the last 10 years. Are semiconductors, or do you have a best idea inside of this tech leadership that is worth discussing?
Yeah, believe it or not, I've been bullish semiconductors going all the way back to 2012. And last year, that was my top pick for 2024. And thank heavens that worked out. I'm not negative semis, but semis are up an astonishing amount, particularly NVIDIA. NVIDIA is up like 800% in 2 years. I think they need a period of digesting those gains. So I'm still bullish longer term, but I don't think they're the star of 2025. So I like software. So very early in my career, I worked with a technology analyst, and I learned that there's cycles to technology that they still exist, where you increase or improve your chip, your semiconductor chip, you improve your hardware, and then you get the software upgrade. I think we're moving into the software cycle. So we're very, very bullish software. So
what would top software companies be? Not just for more of the audience understanding them, because software can be quite broad, but while you share that, I'm going to pull up the software ETF that I think you're pointing to, or you've alluded to.
So one of the largest companies in the space is called Salesforce.com. And this is software is also a play on artificial intelligence, AI. If you listen to the CEO of Salesforce.com during Davos, which happened in September, they're not necessarily investing directly in AI, but they are investing in how they develop their software to use AI. We're moving to a phase that's called AI agents. And in fact, Jensen, the CEO of NVIDIA, has also talked about the next generation of AI is called AI agents. So what's AI agent? Basically, it is your assistant that helps you do work. But it's software, right? So you don't have the physical person, but you have this physical piece of software that actually can help you do your work. And we're in the early stages of AI agents. And that's one thing that Salesforce.com is providing its clients, are these AI agents. So that's an example. Palantir, although it's down very sharply over the past couple of days, is military software. That would be an example. Just kind of like in a different direction. Cybersecurity is a form of software. And so
it's utilizing kind of the semiconductors that have kind of brought these chips and have built that up. It's now, how are we utilizing AI, or how are companies utilizing it?
Correct.
That's the call for new leadership. So
correct.
Last 12 months, essentially in line, but more volatile with the S&P. Great. Super.
So I think that's emerging out. I think that's very early right now.
Would you say that's your pick or that's your call for the 2025?
Correct.
Okay. Love it. All right. Getting back to Washington and this administration, which, yes, there's new news every single day here. How do you expect this new leadership in Washington to impact, say, tax policies for investors or even business owners? What's the impact of all of this change going to have on certain policies? And I know the Trump tax cuts are set to expire in January 2026. Thoughts there?
So Trump, on his campaign, promised a lot of tax cuts. And if you actually sum up all of everything that he promised, I don't know how he's going to deliver it because there's not enough money for it. Mm-hmm. So I know that they're trying to find money in cost cuts, but I don't even think that's enough to pay. So it's going to be very interesting to see what kind of tax cuts he actually can do. I think he has a challenge. Mm-hmm. I think markets just need to know the facts. Will there be disappointments? I think there will be some disappointments, but I don't think it's enough to take markets down. What I think is going to be more interesting and more important for markets are where are we going with these tariffs? Now, it's interesting because Trump used tariffs in his last administration.
Right.
And Biden kept the tariffs. He didn't change them. So I went back to see where inflation was, right? Because the big concern with tariffs is that they're going to cause inflation.
Yeah.
So I went back to see where consumer prices were, the CPI index when he left office. And when he left office, CPI was 1.4%. It was below 2%. So the tariffs that he had implemented did not cause inflation. Part of the reason for that was the tariffs that we put on China did not get passed on, right? It also depends how the country that's being tariffed actually implements that tariff. So tariffs are definitely not efficient. Is Trump correct in saying that we are sometimes unfairly treated? Yes. With Europe, when you compare our tariffs to Europe, and this is generalization, they're almost double. What Europe charges us is almost double what we charge them. So, Trump could easily double European tariffs just to be even. Personally, our view is that Trump uses tariffs as a negotiation tool. Not that he won't implement it, but some of these high numbers, like this 25% number, which the markets definitely don't like.
Yeah.
Because this new one is 25% on auto, semiconductors, and pharma. The way Trump seems to negotiate is he goes way, way, way out in the field.
Right.
And then things get dialed back.
He almost tests it and then dials it back. Yeah.
I think because this way he has more room for negotiation.
How much risk is there to the market or to even some of your calls? How much risk is Trump to that? Because markets don't like uncertainty, and he is a very uncertain leader who's creating a lot of uncertainty. You throw on Elon and what he's doing, and no one knows what you're going to wake up to in the morning, and markets historically don't like uncertainty. So how much risk is this administration to the markets?
So last year, our theme was the bucking bull, that the markets would still go up. And we had 5 corrections last year, and yet we still closed up 24%. I think the bucking bull has carried over into 2025. What all the news that comes out of Washington has a risk of creating volatility. But at the end of the day, if the leadership of the market can post earnings, stock prices over time are going to go up, just like they did last year. I think they can get through this, but from time to time, we'll have volatility within the market. So what that means is that investors have to be patient. And I can understand being unsettled as an investor with what's coming out of Washington.
I'm having those conversations with several clients, and many are unsettled and nervous due to that uncertainty, and the fear of the unknown is, I think, many times greater than the fear of the known.
That's correct. But when we look at history, in fact, I've been doing this for 40 years. It seems every year there's been a reason to pull money out of the markets. And maybe there are times where you can get it right, where you pull money out. There are times people get it right, but you have to get two trades right. If you get it right coming out, you also have to get it right going back in. And that's where most investors fail, is they can't pick the time when to go back in, because believe it or not, the time to go back in is when the news is horrible.
Yeah.
And it's very hard to stomach. So as an investor, we always say to stay invested over the long term. And what you're doing for your clients is what academia has been preaching forever. You set the asset allocation and rebalance when appropriate. And that will help you ride out the volatility over the long period of time. So we've looked at investing during Democratic cycles, investing just during Republican cycles. And none of that works. You give up so much return that it really requires patience. Mm-hmm. That's really the key. And again, try to remember, it's earnings that power stocks. You know, I talk about liquidity. Yes, liquidity will drive assets, but at the end of the day, to keep prices up, the companies have to have earnings. So we have to look at, is there an environment that's friendly for corporate earnings? And so far, we're in a friendly corporate environment, and expect it to even get better under a Trump administration. Okay.
What about, so we've talked a little bit about inflation and what the tariffs are going to do to that, the impact of inflation on interest rates. Do you have a call on interest rates, or even specifically the 10-year? In terms of us managing portfolios for clients and believers in diversification, we own bonds, and the bond market has, pretty highly correlated to interest rates. So what I'm just pulling up is, last 3 years, we've seen the 10-year treasury up double, and then that's created an overall return for the bond market to be net negative. The last 1 year is a little bit different, where bonds are recovering because interest rates have normalized. What's happening with interest rates in terms of your opinion? What do you think is going to happen to the 10-year? Are you're looking at tariffs quite intensely for that as well?
So let me start at the short end of the curve, because I think this is important, because we stopped talking about it. The Fed cut interest rates last year at the Fed funds rate. So that's the short end of the curve, 100 basis points from September through December. Never before in the history of the United States have we cut interest rates so aggressively, or even cut interest rates, period, when the economy was growing and we were at full employment. The type of cuts that the Fed did, we normally see during a crisis of some type. So typically, monetary policy can take a minimum of 12 months. To hit the economy. So we're really not going to see that until around September of this year. Whether or not the Fed cuts rates, first of all, I don't think the Fed needed to cut rates, and we've already cut 100 basis points. So I'm not in the camp that you need to cut interest rates. If inflation does come down, however, I think they'll be inclined to cut at least once more. I think their bias is to cut. The market is expecting a cut somewhere in the fall of this year. That's kind of where the market is. As for the long end, I think on a cycle basis, in the very short term, I think rates can come down. I kind of have them in a range this year between 4% and 5%, because the economy is growing fairly strongly. The consumer is strong. So, having a 5% interest rate would be actually normal. But the market doesn't like 5%.
Welcome. I don't think it would be welcomed by consumers if we have a 5%
No, the market doesn't. The market doesn't want 5%. The mortgage market doesn't want 5%. No. But believe it or not, when we look at history, 5 is normal. So I think what's happening is the Fed, and the market are trying to normalize interest rates. Having a 10-year around 5 or 6% is actually normal.
Yeah.
Now, if we hit 5 or 5.25, because you can technically, from a technical standpoint, get to 5.25, I don't think the equity market would like that at all. Yeah. I think you would get somewhere between a 5 and 10% correction. I don't think it would be a disaster, but the market certainly wouldn't like it. But in the very near term, I think rates can get down to around 4.2.
Okay.
So I think we're in a volatile period for rates at the long end of the curve as they try to figure out inflation, as they try to figure out economic growth, and as they try to figure out the Trump administration and tariffs.
Let's stay on interest rates, and I'll now poise or position to you our national debt, and the interest on the debt is certainly more expensive. That becomes an expense item. What do you think of our debt and where interest rates are and that tie into that equation? So
we do have a very large deficit, and it's not healthy to have a very large deficit, but we've been debating deficits for a really long time. I remember when I was I think I was a junior in college, and we had, a debate with our professors because of the deficit, whether it was a good thing or a bad thing. So, deficits are not a new topic, but this one is particularly large. What's important about the deficit is, can you fund it? Because if you can't fund it, then you have a problem, and then your interest rates get out of control. And the United States, if you really go around the world, we're the prettiest house on the ugliest block. Europe is rattled with political issues, and their economies are still trying to recover. You don't want to really go to the emerging markets. Japan is doing better, but they're raising interest rates from zero bound, right? So I don't think we're going to have an issue funding our deficit. The US dollar is the world reserve currency. The dollar remains one of the strongest currencies in the world. So we can fund the deficit. That doesn't mean from time to time that you can't get concerned about the deficit and seeing interest rates back up. They're called bond vigilantes, come in and sell the bond market and jack up rates. My personal belief is we're not going to default on the debt. We're not going to have a problem funding the debt. When you look at Treasury Secretary Bessent, he's a Wall Street guy. The last thing he's going to do is disrupt the markets. What he is looking at doing, which I think is very important over time, is he's looking at, because most of the debt right now is funded at the short end of the curve. Yellen funded most of it at the short end of the curve. So now you're at risk as rates go up over time.
Sure.
And you don't know where they're going, right? If you're constantly refunding at the short end of the curve. His plan is to, over time, fund it on the longer end of the curve, go out to the 10-year, but he said that's going to take a while. And I think he's saying it's going to take a while because I think he wants rates to come down. And I think if rates come down, you're going to start seeing the funding go longer. And that's going to give us a lot more confidence on what our interest payments are. Because right now they're variable interest rates. If we can get a good longer term look at what the payments are, that's going to create great confidence within the marketplace. And I think that's where we're going. So the deficit does need to be addressed. I don't want to say it's not important, but I don't see it causing us a major catastrophe at this time.
Yeah, love it. Let's talk just briefly. Our positioning has been overweight U.S. relative to international. I'm curious if you carry that same sentiment. It doesn't mean a lot because it's so short term, but if we look at the S&P compared to, say, the emerging markets or emerging market ETF, or, for example, developed markets, including Europe, we surprisingly are seeing, now granted, we're less than 2 months into 2025, but developed markets up 7.5, emerging markets pretty much in line with the S&P 500. Is there anything you're looking for there, or you still believe the U.S. is the market to kind of be overweight? And what would change your thoughts?
So in our year ahead report, basically what we said is we looked at the U.S. relative to the whole world, but excluded the U.S. And the U.S. went vertical. And I said we could have some kind of mean reversion, meaning a catch-up trade where international markets did better than the US. But the question is that sustainable? If my thesis is correct, so this is part of the story. If my thesis is correct on technology being the leader, that's not going to be sustainable, because most of the technology companies are all here in the United States. And I still think tech will be the leader. So I think we're in a consolidation, a digestion phase of the big gains that we had. And eventually you're going to see the US play catch up. So I'm in the view camp right now that the outperformance by non-US markets will not be sustainable throughout the whole year. Doesn't mean that their markets won't go up this year. But I still think, because when we look particularly in Europe, they've broken out to record all-time highs. They've broken out of consolidations. I mean, I do think the move in Europe is particularly strong, but I think the US is also going to continue its strong performance. So I don't see Europe overtaking us.
Got it. Question from the attendees here. So early we mentioned the Trump quote unquote dividend check. Outlets are projecting that to be as much as $5,000 per household. Wouldn't that fuel inflation along with other factors, interest rates and the markets?
Well, whenever you print money, the risk is that you have inflation. So here's I didn't want to get into the weeds, but I'm going to get into the weeds. The market has shifted from a deflationary, or I should say the economy has shifted from a deflationary environment to an inflationary environment. Interest rates peaked in the 1980s, and we went to generational lows in 08, 09, and repeated that in 2020 and 2021. We're not going to see zero interest rates again in our lifetime. We are now on a cycle of inflation going up. We were global. Now we're deglobalization. Now we have deglobalization. We have onshoring, nearshoring. That's all inflationary. The amount of money that's been printed between the Federal Reserve and between the Biden administration is astounding. That I think over the next 10, 20 years, we'll have an inflationary environment, but inflation, again, has a cycle. So do I think in the next 10, 15, 20 years, we can see 10% interest rates again? I do. So I do think interest rates will go significantly higher over time. But where we are in the cycle right now is for rates to come down. But I think this is the last time this will be the last low, and then we'll just keep having higher lows. So we already have inflation. That $5,000 is just adding another check mark to inflation, but it will allow the consumer to spend. It'll allow the economy to continue to grow. It'll allow corporate earnings to continue to grow. So it's not just inflationary, it empowers the economy as well.
Super. So you mentioned if we're bullish and it's a multi-year super cycle, my question's on small cap. Wouldn't you expect smaller companies to run a little farther, a little faster? Or if we're in this environment where earnings are great and things are growing and the economy's moving and the consumer's spending money, what are the thoughts on small cap? Why over the last 5 years is small cap barely up half of, say, its large cap counterparts?
Because they don't have their earnings. It's all about earnings. 40% of small cap companies in the Russell 2000 don't have earnings. So it's really, and even part of the valuation story, they're not as cheap. They're really not that cheap. So I think it's an earnings story when I think small cap, again, everything runs in cycles. When you end a cycle, a new cycle begins. So eventually tech will end its cycle. Growth will end its cycle. We'll go to a value market. So the value sectors will do well. I think that's when small cap will kick in. So I think maybe we get that turn at the back end of the decade, but I was looking for small cap to have a nice bounce in here. I thought with the new administration, interest rates coming down, we could really get a bounce in them, but they're not getting that bounce. There's just no leadership characteristics in them at all. Well,
we're almost kind of hitting the end of the hour here. I wanted to kind of just finish by talking a little bit about alternative investments. As you know, I'm 20 years in the business. This calendar year, you've had many years in the business at Merrill Lynch, which we overlapped. And when I started following you and kind of reading most of what you wrote, and what we've seen is private equity, private real estate, and private credit emerge in terms of availability for investors and the consumers, where it was very much for institutions, endowments, and really high net worth individuals. We're now allocating towards private markets, and we're targeting almost 15% per client in various forms. I listened to your podcast with Stepstone and Patrick McGowan kind of over the holidays, where you were kind of the moderator. So I don't mean to put you on the spot, but do you have a thought on alternative investments as it relates to portfolios? And then is there any area in the private markets that you're following? Specifically, if public small cap or public small companies don't have the earnings, are there thoughts on private smaller companies and what might happen there to kind of finish the discussion for today?
So most of my career, private markets weren't even part of the conversation because wealth management clients couldn't access it. The majority couldn't. But these private companies found you, and they found your clients, and they found that you had money, and they wanted to create products that you could put in your client portfolio. So we're there, right? So I do lean on Patrick McGowan because he does all of the research on the private markets. In terms of asset allocation, I think if you looked at all of wealth management, if they had a 1 or 2% allocation to private markets, that's a lot.
Right.
We're in the very early stages of wealth management actually moving into the private market. So I think it is a growth market. With that said, private markets have done extraordinarily well over the past 3 to 5 years. So the value in some of these are not as great as they were 3 to 5 years ago. That doesn't mean if you own it, sell it, but it means as a buyer, now you have to be a lot more selective and really do your homework in what you want to own is really right. And the hotspot, is all, innovation and infrastructure, data centers. I mean, all the big data center companies they're called hyperscalers. Are talking about investing billions of dollars because at the end of the day, data is really what has the value, right? AI is nothing without the data. It needs the information. So the information is the most critical part of all of this, right? So we're building out these data centers to store all this data. So that's a really big investment theme now.
Sure. Yeah.
It's needed. Building out electricity, right? We don't have enough electricity demand for everything, whether, we're mining Bitcoin or we want to supply electricity to a data center. So those are very, very long-term themes that I don't think are overvalued. But again, you want to really pay attention. Housing, believe it or not, housing. We didn't have enough housing prior to COVID. And with COVID, we still have a major housing shortage. So there's going to be opportunities in housing and multifamily over a period of time. I understand right now it's trying to digest higher interest rates.
Sure.
But housing longer term is a major long-term theme. So I do think the private markets, you're going to continue to see them grow. I think you're going to continue to see wealth management continue to allocate to that space. But we're just saying, just do a little bit more homework in what you allocate to.
Absolutely. I think you need to. Great. Well, Marianne, thank you so much for this. Been a big fan, and it's because you're typically a lot more right than you are wrong. And I also appreciate your boldness to make these calls and put numbers on projections and then stand by it, but then also change as well. So kind of just summarizing some of the themes where it sounds like we're aligned is US stocks over international, large companies over small, we have growth over value, and software companies could be the leadership for 2025. So excellent great information. And again, thank you for being very open and candid with your calls. We have greatly benefited, and our clients have greatly benefited over the last 10 plus years. So thank you.
Well, it's my pleasure. And thank you for having me on.
Absolutely. Take care.
Bye-bye.